Elon Musk is warning us as additional indicators point to another crash. This could be related to politics in the US and soon affect us and our money. The central banks are currently in a big trap into which they have maneuvered themselves. For decades, they pursued a policy of easy money and became overwhelmed. This meant that interest rates were kept extremely low, sometimes even negative. This enabled companies, builders and others who need money to finance themselves on very favorable terms. Do you remember the crypto and NFT hype from 2021? The collapse of Silicon Valley Bank and other mid-tier US banks was just a red flag. Now that the party is over and interest rates continue to rise, there is a potential for a significant crash in the commercial real estate market, especially in the United States. Elon Musk believes that the state of the commercial real estate loan market is the most pressing issue on the horizon. An estimated $2.5 trillion worth of commercial real estate loans is set to mature within the next 5 years, surpassing any other 5-year period in history. Adding to the concern, interest rates have more than doubled, and the occupancy rate of commercial real estate stands at only 60 to 70%. This situation is causing serious worry. Refinancing these loans is expected to be exceedingly costly and could potentially trigger the next major crisis. Another concerning factor is that 70% of commercial real estate loans are held by small banks. The increasing interest rates are imparting a valuable lesson. There is no such thing as free money. The major issue lies in the steady rise of interest rates, which is now placing a burden on those who have already borrowed excessively, pushing them further into financial distress. When these financial obligations require refinancing under the burden of elevated interest rates, it may prove to be financially untenable for a significant number. Such situations notably heighten the risk associated with loans, a fact already evident through instances such as Silicon Valley Bank and various other small to mid-sized American banks. This pattern is equally prevalent within the commercial real estate sector. Should interest rates ascend while a property is financed by 50% debt, the resultant loss stemming from value adjustments surpasses a mere 14%, effectively doubling instead. This financial vulnerability extends similarly to homeowners who have financed their own properties. In periods of low interest rates and escalating real estate values, debt held a favorable position as the so-called equity leverage amplified the return on investment. However, under the prevailing circumstances, this mechanism operates inversely. Utilizing debt for investment purposes tends to be beneficial when interest rates are subdued and asset values are on an upward trajectory. Nevertheless, amid a downturn such as the one currently being experienced, one banking institution's adversity could invariably precipitate a chain reaction, thereby negatively impacting other banks. Furthermore, the debt limit, also known as the debt ceiling in the United States, and its potential implications for not only the domestic economy but also for the European Union, cannot be overlooked. The debate surrounding the U.S. debt ceiling has been intense, and current indications suggest a consensus has been attained, with the Republicans showing a tendency towards compromise. The fundamental query arising in this scenario pertains to the ramifications of this agreement. The repercussions ensuing from elevating the debt ceiling, colloquially termed aftershocks, could equally evoke apprehension. The existing debt ceiling, presently pegged at $31.4 trillion, has been suspended for a period of 2 years as an integral component of the negotiated deal. Essentially, this implies that the United States retains the ability to persist with borrowing without a defined constraint, thus granting it the potential to indefinitely increase its money supply. This provision will remain in effect until January 2025, effectively sparing the current president from confronting this issue during the remainder of his tenure. However, the impacts are not limited to long-term implications, such as a potential $4 trillion debt. There are also imminent short-term effects to be considered. One such immediate effect pertains to the potential advent of a phenomenon known as the repocalypse, which could transpire within the forthcoming 30 days should liquidity be withdrawn from the system. This is a scenario we are possibly on the brink of witnessing, reminiscent of events that unfolded towards the close of 2019. During that period, the repo market, a pivotal segment of the money market, was suddenly beleaguered by a liquidity crunch. Consequently, interest rates on short-term borrowing surged dramatically, necessitating intervention by the U.S. Federal Reserve. The institution was compelled to infuse liquidity into the system to stabilize fluctuating interest rates and eventually restore equilibrium to the market. A comparable situation could materialize if the U.S. Treasury and Federal Reserve simultaneously retract liquidity from the system. The Treasury General Account, TGA, essentially functions as the U.S. government's account with the U.S. Federal Reserve. All federal income, encompassing tax revenue and earnings from the issuance of government bonds, is deposited into this account. Concurrently, all federal expenditures are deducted from it. A withdrawal of liquidity from the system could precipitate a swift decline in available liquidity. Consequently, this could induce a surge in interest rates pertaining to short-term loans. Under these circumstances, it might become increasingly challenging for banks and other financial entities to secure or borrow short-term loans. This scenario could escalate the probability of bank failures, especially among smaller financial institutions. The reverberations of such occurrences would profoundly impact regional banks across the United States. Specifically, examining the public-held federal debt, the segment of total federal debt owned by individuals, corporations, and indeed, foreign governments, forecasts indicate a rise from 98% of GDP in 2023 to 118% in 2033. This signifies an average annual surge of 2 percentage points. Throughout this duration, the escalation of interest costs and mandatory expenditures is anticipated to outpace the growth of the economy's revenues, thus exacerbating over-indebtedness. These elements are expected to persist beyond 2033, driving federal debt to an alarming 195% of the gross domestic product by 2053. Excessive debt could necessitate the government to allocate a substantial portion of its revenue towards servicing interest payments. Heightened interest rates and diminished liquidity could decelerate economic activity and induce amplified fluctuations in financial markets. Subsequently, the U.S. Central Bank might be compelled to intervene once again in a bid to stabilize interest rates and inject liquidity. However, even such intervention might have long-lasting repercussions, especially if the U.S. Federal Reserve was to adopt unconventional monetary policy measures. Indeed, the balance present in the Treasury General Account, TGA, can exert an influence on liquidity within financial markets. When the government borrows, for instance by issuing additional government bonds, and subsequently parks the funds in the TGA account, liquidity is effectively drawn out from the financial system. Conversely, as the government continues to expend money, that liquidity is reinfused into the system. The issue arises from the fact that, due to the pandemic, the U.S. government has augmented the money supply by approximately 40%, escalating the budget from around $4 trillion to $6 trillion. This situation necessitated the government to resort to borrowing for procuring funds, which is achieved by issuing government bonds. It's projected that $1 trillion will be expended in June, with half the sum dedicated to servicing interest on pre-existing debt. Essentially, we observe a form of Ponzi scheme in action here. The remaining half constitutes the U.S. Treasury's cash balance deposited into the TGA account. Historically, a replenishment of the TGA account has led to a withdrawal of liquidity from the economy, thereby causing a depreciation in share prices and other assets. Similarly, a bolstering of the TGA account could potentially result in fewer funds being allocated to other investments, thereby diminishing risk-taking behavior and potentially heightening the likelihood of bank failures. This situation poses a particular risk to smaller banks in the U.S., which are already grappling with challenges. This aligns with the cautionary note struck by Elon Musk. If both the Treasury General Account and the U.S. Federal Reserve withdraw liquidity from the system concurrently, it could trigger a deeper and abrupt contraction in market liquidity. This could potentially inflict adverse effects on risk-laden markets such as cryptocurrencies, Bitcoin, and naturally, stocks. 5 plausible scenarios that could consequently unfold are as follows. Firstly, there could be an escalation in interest rates. Should the system's liquidity diminish, interest rates on short-term loans could surge, which would be unfavorable for regional banks. This could render credit more costly, possibly leading to increased expenditures for businesses and, undoubtedly, consumers. The veracity of this scenario will be tested on June 14 when the U.S. Federal Reserve deliberates on interest rates. Secondly, we could witness bank failures. In an environment where interest rates are rising and liquidity is becoming constricted, banks and other financial institutions may encounter greater difficulty in securing short-term borrowing. In severe instances, banks may even struggle to repay or service their debts, which could potentially culminate in bank runs. Thirdly, an economic slowdown may be on the horizon. Contracting liquidity and escalating interest rates could retard economic activity. Businesses might face challenges in obtaining funding and executing their operations, which could essentially precipitate a slowdown in the overall economy. Fourthly, volatility in the financial markets could intensify. The uncertainty engendered by these conditions could provoke heightened volatility in financial markets. This could result in larger oscillations in the prices of stocks, bonds, cryptocurrencies, and other assets. Lastly, interventions by the U.S. Federal Reserve Board may become necessary. In order to stabilize the situation, the central bank may be compelled to intervene in the market. It could engage in actions to essentially provide liquidity, that is, to increase the money supply and stabilize interest rates. However, such interventions could potentially have long-term ramifications, particularly if the central bank is forced to resort to unconventional monetary policy measures. As Elon Musk has underscored, this could pose a significant imminent issue that many continue to overlook. But how might we brace ourselves for such a scenario? Foremost, it is critical to remain well-informed and adopt a proactive approach. This entails cultivating a diversified portfolio, investing across various asset classes, and achieving a broad distribution of assets. We should also conscientiously manage our debts and endeavor to keep them as minimal as possible. Exorbitant debt can precipitate major complications in times of economic uncertainty. Additionally, it would be prudent to solicit expert counsel and contemplate carefully about our strategic positioning. Lastly, but by no means least, it is vital to maintain composure. Markets are cyclical in nature, and crises will invariably emerge and subside. The crux lies in preparing as effectively as possible for the forthcoming challenges through foresight planning, disciplined decision-making, and robust risk management.
Thank you for watching. Don't forget to like and subscribe for more great content in the future.